This is the current federal tax developments for the week of February the 16th, 2026. Current federal tax developments are brought to you by your state society of CPAs. Med Zollers, and I am broadcasting this week from back here in Phoenix. We're going to go over what's been happening this week in taxes. And we have a number of cases this week that will cover some procedural issues, some substantiation issues, and consolidated returns. So our topics this week, we're going to start with a surprising turn Denham Capital oral arguments regarding the limited partner exception. Those can get TEFRA jurisdiction, and whether or not the First Circuit even has the ability to decide the question. Next, on artificial intelligence, we're going to review a cautionary tale about using AI for legal research in the Klinko case. Third case up, we're going to look at Section 183's profit motive. This is a taxpayer win a Section 183 hobby laws case involving a ranch. We're going to take a look at the difference between a rebate versus non-rebatable refunds, shall we say, in the case of L versus Commissioner. We're going to talk about a civil fraud case. This discussion on substantiation failures that led to fraud penalties for a CPA in a tax court case. And on consolidated returns, we have a district court case dismissing a refund suit due to strict adherence to the consolidated return regulations. That is, the court strictly adhering to them, not the taxpayer. So let's go on to our first case here. This will be the case of Denham Capital Management, LP versus Commissioner. This is case number 25-1349 in the First Circuit Court of Appeals. We're talking this week are the oral arguments that were held on February the 5th. So this case is part of the ongoing litigation that we've had regarding the limited partner exception to self-employment tax under IRC Section 1402A13. So let's take a look at some of our overview, context of the case. The First Circuit heard oral arguments earlier this month. The panel consisted of Judge Behrens and Judges Lipez and Rinkelman. Now, the core dispute, the tax community has been closely watching this case because of the substantive split on limited partner exception. Specifically, does the exception apply based on state law limited liability, as the Fifth Circuit held in Serious Solutions, or is it based on a functional analysis of activity, as the tax court held in Sorobon? However, the oral arguments here took a bit of a surprising turn. Instead of focusing on limited partner definition, the panel spent the majority of the hour-long session on a threshold procedural issue. The court focused on whether the tax court actually has jurisdiction under TEFRA, Tax Equity and Fiscal Responsibility Act of 1982, to determine net earnings from self-employment in a TEFRA exam. And really has a big impact on the outcome and how they may go down the path on this, because with all that intense scrutiny on the procedural aspects, there's a real possibility the court could dispose of the case on jurisdictional grounds, which would leave us with basically no new information about how to handle this question about whether somebody is or is not considered a limited partner for self-employment purposes, which is kind of the big issue in all of these cases. So the key question is net earnings from self-employment a partnership item? Now, according to Denham, who's the appellant, they did challenge the tax court jurisdiction, and they argue that net earnings from self-employment, that's not really a partnership item as defined by TEFRA, therefore cannot be adjusted in a partnership level proceeding with the issuance of the FPAA. Now realize that doesn't mean, in essence, it's not an issue to be decided in this type of a TEFRA partnership exam, whether or not these taxpayers are actually self-employed, right? And what Denham points to is IRC Section 6231A3 prior to its repeal. Remember, this is also the quirk about if they go down the TEFRA route in this case, is TEFRA no longer applies. The TEFRA partnership rules are no longer part of the code. And that's kind of an issue that we have, that also separately means that we're not going to find out much going down this path, except it would be a way for these partners to get what's going to be, as a practical matter, a win at least on those years. May leave things open for the future, but at least on the year the IRS challenge, they'd get a win there, and you take the wins you can because it's probably going to be a couple $1,000,000, shall we say, as I recall the numbers here. Well, maybe not quite that high, but still going to be a decent amount of money. So, going to be worthwhile to take our win. Now, in order for an item to be a partnership item under TEFRA, a provision of Subtitle A of the Code must require the partnership to take the item into account for the partnership's taxable year. Now, the counsel for Denham argued that while Form 1065 requires reporting net earnings from self-employment, that requirement comes from Subtitle F, which is Procedure Administration. They contend that merely reporting an item does not constitute taking into account under Subtitle A for income taxes. In essence, Denham argued that net earnings from self-employment is a derivative calculation made at the partner level based on the partner's specific status, rather than determination made at the partnership level. And in essence, somewhat that has a little bit of attraction, although maybe a bit more if you're actually using the functional test. It seems very difficult to perform a functional test analysis truly on a partner at the partnership level. At least it seems a little more involved. It seems to be has much more involved with what the partner is doing as opposed to what the partnership is. So we'll get there. But in any event, they claim that since net earnings self-employment is at most an affected items, which only requires partnership level determination rather than a unified partnership proceeding. So that's their classification, saying tax court had no business even accepting. Listening to these arguments, they should have dismissed the case out of hand. Now, the court did push back a little bit on jurisdiction, right? Judge Lipez challenged the appellant's view that net earnings of self-employment is purely a partner level calculation. He suggested that net earnings of self-employment is inescapably linked to totality of partnership income. Logic is you cannot calculate net earnings of self-employment without first determining the partnership's income deductions and credits at the entity level. Now, this line of questioning supports the view that net earnings of self-employment is conceptually a partnership item because it derives directly from the entity's operation. Now, Chief Judge Barron scrutinized the statutory test of now repealed TEFRA provisions. He questioned whether the phrase under any provision of Subtitle A modifies the term partnership item or merely modifies taxable year, referencing the Federal Circuit's decision in Keener, which dealt with similar statutory construction. Judge Barron also raised a practical point. If the tax forms, Form 1065, require the partnership to report the information, does that not inherently mean the partnership is taken into account? And a critical procedural point discussed was the concept of the bypass rule. The court noted that it cannot skip the jurisdictional question to rule on the merits unless it rules in favor of the party challenging jurisdiction. Therefore, the First Circuit intends to affirm the tax court. If the First Circuit intends to affirm the tax court and rule against Denham, then it must first decide it has jurisdiction. You're not allowed to decide it. It's irrelevant what your decision is in that regard. Now, they did move on to, okay, if that's not the case, then let's take a look at the issue that's been the issue everywhere else, this concept of limited partner as such. And that's the key dispute. 1402A13 excludes distributive shares of a limited partner as such from self-employment tax. Now, Denham argues that in 1977, when this statute was enacted, the term limited partner was defined strictly by state law limited liability. They contend that the court should look to the definition as it was understood at that time to determine how to handle this particular matter. The IRS interprets the phrase as such to be a clarifier, or I should say the appellant, in this case, Denham. They intend that phrase to be a clarifier intended only for dual status partners, those who held both general and limited partnership interests. They argue it ensures the exception applies only to the limited interest portion. Now, Judge Lipez was skeptical about this one. The judge expressed doubt about this interpretation. He noted that limited partner is a legal consequence of a status. However, the phrase as such implies a capacity or a role. And because remember, part of the argument is, which was what the Fifth Circuit was that limited liability was the key issue. And, the judge is saying, well, yeah, that's an attribute you have. But as such indicates your capacity or role. You simply have limited liability or you don't. That's not something that you earned or did something for. And saying, so Judge Lipez suggests the governor's passive investor test fits better with the as such language. And of course, the IRS supports that idea, right? It says, follow cases like Sorobon and Rankmeyer. This test looked whether a partner is merely a passive investor or is actively involved in the business, and that's the proper way to interpret it. So, interesting takeaway here, but we'll keep going on that realm. Now, we're going to look at dictionary definitions because that was brought up. It's been brought up both in Sirius and in this case now. And Judge Reichelman countered basically the taxpayer's 1977 definition argument by citing a 1968 Black's Laws dictionary. And she noted it defined limited partner as one who's responsibility restricted, which supports a functional role-based analysis rather than just a liability shield. In essence saying, and again, Black's Law Dictionary, fairly significant document in legal circles. And she's saying that's the definition at the time. And it did say about limited liability, but it also noted that you had restricted responsibilities in there. And Judge Barron questioned the logic of Denham's position. He asked why Congress would intend to exempt basically full-time employees from Social Security taxes merely because they benefit from limited liability under state law. Or we should say, and he did use that term, that this came directly from the oral arguments. So don't want to change the term, but effectively telling us people who are equivalent to full-time employees from that definition because they have limited liabilities. Now, the IRS argued the label limited partner is not controlling. And they cited the Delaney, a case 1977 era, I should say, even though back then, if a limited partner exercised control, they lost their protections. Thus, they claimed a functional analysis is consistent with historical intent. So, while the Fifth Circuit rejected the functional analysis in Sirius, the First Circuit panel appeared much more sympathetic to the governor's role-based interpretation. However, despite their positive view of the merits for the government, the jurisdictional hurdle remains. If this panel decides that net earnings for self-employment is not a partnership item, they would vacate the tax court decision and effectively leave the fundamental question of what exactly is a limited partner for 1402 circumstances still unresolved in the First Circuit. So for those of us not involved in the actual litigation of the case or a case like this, where we're just trying to get our, I'm sure counsel for all those involved want to get their clients out from writing big checks for the year in question. For those of us that want something going forward, because again, remember, TEFRA is a bit dead end street as well. We would probably prefer they didn't decide it on jurisdictional grounds, but I think there's a high chance they will. So, what we have are nice little infographics, again, brought to you by Notebook LM. Okay, so this is a roadmap here of the complex arguments in Denham. So if you take a look at the jurisdictional, the left side of the video of the graphic you have on your screen, it illustrates the threshold issue. The court must decide if net earnings from self-employment is a partnership item, because those are what are decided at the entity level under TEFRA, or if it's an affected item. That is one to be cited by each partner, and the IRS would have had to open up each partner's return for examination on this issue. If it's the latter, the tax court lacked jurisdiction in the proceeding. And the other important thing is, unless the IRS has somehow gotten the partners to leave the statute open for everything on their returns, they're too late to the game, right? The jurisdictional side means we're late to the game. My take is that given the way that the partnership is prosecuting, that, is basically is going forward with their case, I think that year is going to be closed. I think that's going to be a win for them if they get it. Now, right, it is basically going to be the idea here of the subtitle A conflict. And as I said, we're pretty much done if that's true. Now, the right side of this deals with the substantive issue in this case. Because again, the first one is procedural. But if they go that route, because if a court doesn't have jurisdiction, It doesn't matter the other parts. They have no right to decide this issue. So the flip side of it, if they do get past that hurdle, which, I mean, the odds don't seem favorable, but it's possible if they did, then we have the two competing views of limited partner that we have had two courts say, give us enough ruling on. Under serious view of the Fifth Circuit, if you have limited liabilities under state law, you are exempt. Now, under the tax court view in Sorabon, you must act as a passive investor to be exempt. And please remember, Sorabon is a published tax court decision. As of this instant, as I'm recording this today, if you're in any circuit except the Fifth, your clients have to understand that they do not have an ability to go to tax court effectively to challenge this. Because what's going to happen is, if they go to tax court, we'll have to go there, but it's going to be just kind of in passing. If you go to the tax court is going to rule that we're going to look at your functional tests and not pay any attention to the fact that you're a limited partner. You'll then have to talk about, okay, how would this case be decided at the next level? In my case, being here in Phoenix, we're going to have to be kind of willing to go to the Ninth Circuit or pay the tax, sue for a refund in the Court of Federal Claims, Court of U.S. Court of Federal Claims, give the right name. Its name's changed over the years a few times. Because we don't know. The Federal Circuit hasn't ruled on this yet. So there's a possibility we win there, but we've got to pay the money up front, which is usually not what our clients want to do. So right now we're watching, and while there are cases moving through the country, some are far further along than others in terms of getting before a circuit court panel. And we know that Sorabon has moved to go before the Second Circuit. So we're going to have a few more coming up, and I think more will come in the future. But right now, only in the Fifth Circuit, can you say, state law limited partner with limited liability, because that's how they phrase it, which is awkward phrasing, but we'll accept that. As long as that's true of your partner, they're not subject to SC tax per the Fifth Circuit, and the tax court has to follow that precedent if the case would be appealable to the Fifth Circuit. But, if you're not in Texas, Louisiana, and is that Mississippi is in the mix too? You're not in one of those states, we're not going to be able to use that one. So we got to kind of look for something else at this point. So we're waiting for other cases. Now, the as such state is a statutory interpretation battle. Does as such mean in the capacity of passive investor, or does it simply distinguish limited interest from a general interest held by the same person? And obviously, there is a split currently. We have the conflict between the Fifth Circuit, right, which is serious, and the tax court Sorabon. Remember, the tax court's a national court, but it does have to follow the courts of appeal in their jurisdictional areas. So while it's a national court, the cases get appealed to the geographical circuit courts of appeal. That means that we get this weird thing where everywhere but the Fifth, right now, per the tax court, you come to us and we're going to say, we don't care, you're a limited partner, what'd you do? If you go to the Fifth, we don't care what you do. Are you a limited partner with limited liability under state law? That's the big issue. Okay, next up, Klinko v. Commissioner, a tax court Moran decision, 2026-16, came out on February 9, 2026, and this gets us into the discussion of AI, artificial intelligence. There's also a substantiation issue here that we'll get to. But the more interesting part is looking at AI in tax, and I use AI in tax. I use AI when I'm putting together this stuff every week. It definitely can be, as I tell people with AI can be in tax. AI is incredibly helpful, can incredibly speed up a number of things, and is insanely dangerous. In Klinko, we find the insanely dangerous portion of this. Okay. But don't forget the first two, because if you're not paying attention to the first two, you are very likely, unless you're retiring within a year or two, you are very likely going to get left behind. you better start paying attention to AI, its tools, and its capabilities. But there's care, there's lots of things happening. But let's talk about Clinko, right? So there are two different themes in the case. The general issue of, this is nothing unusual. You got to prove deductions and income, and 99% of tax court cases, I'll actually say, looking at the opinions, tend to come down to the fact the taxpayer didn't have sufficient, evidence to prove their deductions. And that's the problem. And they also, didn't have decent records, so the IRS reconstruction of income would work. That's less likely to be the case, but in this case, that was there too. Neither one of those are unusual things in the case. What made it unusual was the ethical peril of using AI tools for legal research without verification. And those last two words are important. Without verification. That's where you're going to find the problem. Okay. Now, this did prompt a rather stern warning. Judge Holmes' opinion is notable for a blistering critique of the petitioner's brief, who was counsel that represented himself, right? It contains citations to cases that do not exist. That is the concept known as AI hallucination, right? AI will at times make up items. If it has nothing that it can find, it will turn and make things up. So this case involves, an attorney and entrepreneur who operated a law practice and a restaurant, Med Cafe, like a perfectly good combo. And the dispute centers on the unreported income and unsubstantiated depreciation in this context. So let's go on to what the judge called the AI souffle, right? Now, the issue was that the taxpayer raised procedural challenge against the validity of notice of deficiency. They argued it was invalid because it lacked a wet pen and ink signature from an IRS employee, instead bearing a digital or delegated signature. Now, in his brief to support the argument that the physical signature is required, the petitioner's counsel submitted a brief citing three specific cases: Cachillo versus Commissioner, Miller versus Commissioner, and TEFRA versus Commissioner. Now, the reality and where the problem came. Upon review, the tax court discovered that these cases do not exist. They are completely fictitious citations and almost certainly generated by a large language model. Now, Judge Holmes got creative, like the AI souffle, and he talked about the fact to describe the failure, he used lots of food metaphors, stating that the persuasiveness of Clinko's argument collapses like an overmixed food souffle once the citation were examined. The opinion notes that the bouillabaisse of case names, reporter citations, and legal propositions suggests something cooked up by AI. And basically, we're talking here about AI's hallucinations. As I said, AI is a couple of biases in it. One of which is it likes to please, and it really doesn't like saying, I don't know. And I'm afraid it doesn't really have it's not really making the decision that way, unquote, liking. But the way they've been structured, the way they've been scored, and the way they've been optimized, they get scored for giving right answers, and we don't care. And giving no answer is equivalent of giving a wrong answer. Well, that sounds like a good way to do it. What it tells you is something, if you ever remember taking an exam and just making a wild guess, because if you don't put anything down, you're going to get the question wrong. You put a wild guess down, you probably are getting the question wrong, but who knows? Maybe whoever's grading this will buy it. Yeah, that's how AI works. It's submitting answers at times. It doesn't really have anything to go with, but maybe, just maybe it could convince you this is right. And unfortunately, in this case, it convinced the taxpayer that this was right. That's not good, right? That's the concept of hallucinations. Now, that's not the only problem we have with this. AI can also basically, it can give you a perfectly valid case, but then it didn't really say what it says. That's a close relative to hallucination, but it did at least find something that existed. And that's actually a little more dangerous because you can't just check to see if something exists. The good news in this case, you could check these cases, and it's pretty clear they don't exist. Right? The citations go into the middle of other cases. You actually follow them. And the final problem, which is one that sometimes occurs, is it does have a source for what it's saying, but the source got it wrong. And that's a big deal, as I think I've mentioned before on my edzollercpa.com website. I have a couple of articles there discussing the above the line phenomenon for certain deductions under the Tax Cuts and Jobs Act, which, by the way, added nothing, outside of business deductions and deductions that would go on business or rentals. That would be above the line for an individual. But yet, there's a lot of talk out there. And AI, for a long time, it's getting better now. For a long time, though, it would tell you that there were 4 above-the-line deductions added. And the problem is, and by the way, Claude was very aggressive on this when I pointed out to Claude the error, pointing out how many human-generated articles had gotten it wrong the same way. Sometimes you've got poison data. The above the line phenomenon is not a hallucination because every AI wouldn't come up with the exact same answer if they were hallucinating. They got something for this, and that was when he quickly determined that we have poison data out there. There are things coming from apparently very reputable sites that simply screwed up the analysis and call these deductions above the line because they read the part that said you get them whether or not you itemize, and they go, wow, that means they're above the line. As we know, no, it doesn't. So that's kind of where the issue comes in. Okay. Now, here's what the court did. They investigated citations provided. For instance, citation provided for Cachillo, right, which got the citation of 130 TC 132. 130 tells you the volume, right? It's a tax court's reporter. And 132 is a page number. And it's put you in the middle. If you actually go get that and look at that page, you'll be in the middle of an unrelated case, Porter v. Commissioner. It has nothing to do with this. Beyond mere fake cases, the legal argument itself was baseless. The court itself cited a real case, Tamano versus Commissioner, in the Internal Revenue Manual to reaffirm that delegated digital signatures are valid on notice of deficiency. Now, the judge explicitly referenced Federal Rules of Procedure 11B. It requires attorneys to certify their legal contentions are warranted by existing law. That's nothing new. That's been around way before AI. And one thing it's telling me, which is probably maybe not surprising because I've talked to certain, law professors and things like that, or other similar backgrounds, who have noted that people are way too trusting of third-party sources for legal research. And I suspect that there are a lot of cases that if you actually track them down, somebody put a citation in there and they took it from an article, maybe a BNA tax portfolio, something of that sort, their tax reporting service. But they never actually looked at the case to make sure the case said what's being claimed. And sometimes those sources get it wrong. You need to check third-party citations, period. 11, and now I know 11B only involves for civil cases in the courts, and you're not doing that probably. But bottom line, this has always been the law. This is the toughest thing I'm getting through to people. AI is not unique in that area. AI is unique in the fact that it may be more likely to throw this up, but you're in the same bit of hot water if you used let's say, I don't know, there was something got by the editors in the Federal Tax Coordinator, and you cite a case that totally doesn't exist, or has nothing to do with the matter in front of you. But you cited it, because you just got to that page. Now, one of the first things I was taught early on in my tax career was Research does not mean reciting editorial materials. Right. To quote the person was the founding, basically founded the firm that I'm part of now and own now, a part of, who passed away many years ago. But his line was simple. Wolters Kluwer's, and at that point, RIA, right? So let's say CCH and RIA, now Wolters Kluwer's and Thomson Reuters, are not listed in the U.S. Constitution, and their editorial commentary is not considered to be valid. Ultimately in the courts, you have to go back to what they're supposed to help you interpret. They are pointers to valid. They are pointers to hopefully valid information, and that same thing is true about the AI. But it's still up to you to go look at the actual stuff they're pointing at. Don't just cite from the editorials. And I have said that for years, and that's why the AI to me makes much more sense. Because I'm not using it any differently than I use the other stuff. I question. If you're not questioning it, you will get burned. But that's true if you're just not questioning any third-party source. Okay? In any event, as the court said, submitting a brief for fictitious case law is a recipe for sanctions. It's a recipe for a malpractice case. If let's say you're representing somebody at the service and you're pushing a case forward, or you took a position on a return, and it turns out you based it on what's just a non-existent support, you're supposed to catch that, right? So this case is an alert for practitioners. While the court did not impose sanctions in this specific instance, because it's really the first time the tax court's dealt with it, it did make clear that AI-generated research must be rigorously verified. And that is true even if you're never going to court. You're using AI research, you must verify it. But I'm going to add to that if you're using any third-party product. If you're not going directly from the primary sources, and more importantly, you're also not verifying that those primary sources have not been overruled by later changes in the law, or changes, or basically overruled with a court appeal. Yeah, that's part of our job, whether we like it or not. Okay. Now on to the more mundane parts of this case. The IRS reconstructed the income from the restaurant, Med Cafe, using the bank deposits method and information return processing data. So in Form 1099 Miscellaneous and 1099-K. The audit revealed a massive gap between reported gross receipts and third-party credit card sales data reported to the IRS. We're just kind of short $2.3 million. Penny change, right? Now, the taxpayer argued that the deposits were not income, but were capital contributions from personal funds or loan. But the problem is the burden's on the taxpayer here. They had to show deposits were non-taxable. While the IRS conceded $82,000 in substantiated capital contributions, the rest are deemed income because they couldn't support it. You say, that's all capital contributions, right? Judge Holmes noted that an email without more is insufficient proof of a loan or contribution. He also dismissed the argument that a money-losing business cannot have unreported income. He said even money-losing businesses can underreport their income, right? That's it. You can't just say I'm losing money, so it doesn't matter because, well, then, yeah, it does. That's not good enough for your argument. Now, also on deductions, the taxpayer claimed $56,798 depreciation on Schedule E for 2 rental properties in Pasadena. The taxpayer failed to produce invoices, closing statements, or any records establishing the basis or placed in service dates for the property. The prior returns aren't good enough to do this, guys. Bottom line. I know he bought it 10 years ago. That's outside statute. No, it's not, because we need that for proof of the deduction this year. And as I want to tell everybody, remind you of this, the statute only limits what years they can collect tax from. It doesn't limit how long ago they can look for information. If you're claiming depreciation today for a building you acquired in 2005, despite that being 20 years ago, if it's a commercial building, you're still depreciating it. You got to have the information from the purchase back in 2005 to establish the basis today. That's got to be part of your records. Be very careful telling clients they can get rid of everything after 4, 5 years, 6 years. Clients want to hear nice, easy rules like that. The rules aren't that easy. Anything that could impact a return that we're still within the statute for the IRS to assess tax, we need that data. And I mean anything that could affect how you compute the tax there. That can include NOL carryovers, which also means that could go way back. Because you got to prove not only that you had the actual NOL in the year it was incurred, which really means I got to be able to do everything for that return, but I also have to show it's never been absorbed, which effectively means I got to be able to prove the correct income for every return, every year, all the way up to what I'm claiming today. And if you think that's crazy, and nobody has to keep that much data, court never enforces it. Court enforces it. There have been numerous cases over the years where NOLs are thrown out, right? Okay. Now, his defense was that they claimed the same depreciation deduction in a later tax year, and the IRS had not disallowed it then, right? The court said, I don't care, citing IRC 6001 and Section 167A. Basically, the court reiterated taxpayer must substantiate base and useful life, and the fact the IRS didn't challenge you another year doesn't matter. It's like defending your speeding ticket because, I've driven down this highway, for 5 straight days I went down this area, I've been doing this week, and finally here on the 6th day I drive, you stopped me. Well, that's illegal. You said it was okay. No, I didn't. I just didn't charge you. I did now. As the court noted, what you're asking for there is the audit lottery defense. And the court ruled that whether Klinko claimed the depreciation in a later tax year is no proof he was entitled to depreciation in 2015. The fact the IRS didn't challenge you really doesn't matter, right? That's not the issue. So now we have our souffle. Graphics, you knew a souffle had to come out of the graphics, right? Yes, we have our AI souffle, right? The real issue here is legal ethics and AI hallucinations, right? And the recipe for sanctions. It is really, really, getting into this background. Remember, the unsigned notices, which was this whole fight over this, they're valid, right? There was a massive amount of underreporting. So $2.2 to $2.3 million because 2.2 says 2.3, but we did reduce that by 80,000. So 2.2 million, right? In those receipts, it breaks down the source of unconstructed revenue, 10.9K, over 2 million, estimated cash receipts, and it reaffirms, the bank deposit analysis burden of proof. The taxpayer must prove deposits are non-taxable, capital contributions. Klinko failed to do that. So, end of the day, the souffle didn't hold up very well. Next up is Kolar versus Commissioner. Tax Court Decision 2026-15 decided on February 9th. Now, this is a taxpayer victory regarding hobby losses under Section 183. Section 183 hobby loss disputes are common when taxpayers have dual purpose activities like ranching that generate consistent losses offset by other substantial income. And this case is a roadmap for defending such deductions. It shows us that even with troublingly large losses and high outside income, the taxpayer can establish a profit motive if they conduct it with activity, professional rigor, and business-like intent, which does include being realistic about when you want to, basically have to kill it off and say this thing's just not going to work. That's also one of the problems we run into. A key issue I've noticed with clients, if they have a hobby loss problem, they start getting overconfident because the IRS has never challenged it. It's like, no, the longer you go, the tougher this is to defend. Having 25 years of huge losses, the 26th year doesn't make it better for you, right? It makes it worse. And that's what's difficult to understand because they get nobody ever called me on this. I don't know anybody that's ever had this happen to them. Great. But I can point you to tax court cases over the years where suddenly something comes up that's never been raised before. And as noted, the court does not consider that a defense, right? So let's talk about this particular case. The central dispute was whether Section 183 limited deductibility of farm expenses for the 2016 tax year. And the IRS argued that the ranching activity was not engaged in for profit. So Kevin Kolar Jr. inherited the Kolar Ranch, which was a family property held since the late 1800s. By 2016, the ranch was in disrepair. So this is when Kolar took over, with a plan to restore the infrastructure, clearing invasive trees, rebuilding fences, and the herd. A significant factor weighing against the taxpayer was the presence of substantial outside income, which often suggests an ulterior motive for this activity that's losing money. And the hitch here was Kolar received over $2.3 million in oil and gas royalties from the property during the year in question. So is he really doing ranching work, or was he simply doing something he found enjoyable that, he then could basically have subsidized by the tax savings of, not having to pay tax on the $2.3 million or parts of that because it's going to offset it with these losses. And like I said, the financials were stark. Over $2 million in losses compared to only $25,000 in gross receipts over a 5-year period. Let's say the ranch was not very successful, right? And despite this troublingly large losses and high outside income, the court still found he had a profit motive. It's not absolutely hopeless, even in a case like this, but you have to understand why Kolar prevailed. And that's important in this case. Now, first thing he did fail at. Kolar attempted to aggregate his activities. He argued the activities should include the cattle ranching, the appreciation of the land, and the oil and gas royalties. Now, this would have offset the ranching losses with the oil profits. And, the theory is that it's profitable. Not hugely, but it's profitable. Now, the court rejected this aggregation. Citing Young versus Commissioner, Tax Court Decision 2025-95, the court noted that land appreciation is generally a separate activity unless the farming itself is profitable enough to support holding the land. Since the ranch was losing money, land appreciation could not be grouped with it. In essence, just you're not really adding anything to it by farming it. Right? You'd have been, if the appreciation of the land was what you were mainly going for to make money, you didn't need the farming. Right? Now, if the farming itself is working, then we got a little different rule. Right? The court also ruled that oil and gas extraction is fundamentally different enterprise from ranching. Despite they are geographically in the same area and they shared roads, they are simply distinct undertakings. Right? You got to separate those two. They're wildly different things. Consequently, the court isolated the ranching activity generally as a specific activity to be tested. Kolar had to prove a profit motive for the cattle operation standing alone. Remember, these operations that effectively had $2 million of expenses over 5 years and only $25,000 worth of income. That ruling looks bad. That makes it look dark for Mr. Kolar. Okay, but here's where things came in. The court found that Kolar operated in a business-like manner. He maintained a separate checking account. He had a rigorous record-keeping system managed by his wife, including daily logs and monthly spreadsheets. And by the way, it's pretty clear they're being done at the time. And the lack of a formal business plan was excused because his credible testimony outlined he had a clear plan for herd restoration. You could ask him detailed information. You got consistent answers that were well thought out and that made sense. So there was a business plan, it just wasn't written. Expertise, Kolar held degrees in animal science and biology and had lifelong experience on the ranch. The court rejected the IRS argument he lacked economic experience, noted that he understood market pricing. Time and effort. Kolar was not a dilettante, basically just sitting out there and, who just did it, for dressing to look good. He worked full-time on the ranch. He performed hard labor. He didn't just basically sit there and watch things happen, with having hired people do all the stuff that might be, not as much fun, right? Difficult. And he just got the good stuff. Now, the IRS claimed, and this is also something that's very key, that this ranch was for personal recreation. And that quite often is, that's a fatal pairing. Lots of other income to allow you to do this, and it's something that's really enjoyable. But the court in this case dismissed that, noting Kohler didn't ride horses for fun or attend shows, right? Explicitly stated that training his children to take over a family business is consistent with a profit motive. That's not personal pleasure. They're saying they didn't see any personal pleasure. They didn't see any use of horse that wasn't consistent with running a ranch and training his kids to take over a ranch that had been in the family since the 1800s. So, while all of that, now you change those facts just slightly. You have somebody who had hired help take care of all the stuff that was not fun, and he just rode horses, didn't actually do any ranching work on horses, but he rode horses because it looked good. He got pictures, right? And if that's all he did was rode horses, went to shows, that's a very different fact pattern. You've got to be very understanding about where you're going to have the positive versus the negative factors here. What were the factors against? And there were some. And the conclusion that losses were substantial, right? And the court admitted this was troublingly large, which tells you even with this, he's teetering on the edge, right? The court accepted that the ranch was in startup phase. That's huge. In essence, that big of losses suggests normally that you would be thinking of shutting it down. But then if you think about that, since we just had an AI section, OpenAI has had nothing but, just absolutely absorbing cash left and right. But they're so far not talking about shutting it down because it's in the startup phase. This one's in the startup phase revitalization. And there were unforeseen setbacks. There was Hurricane Harvey, there was a COVID-19 pandemic, and a big winter storm in 2021 that essentially helped explain the losses. So, in essence, it is not absurd to keep trying to make this ranch make money, given what has happened in the years in question and the fact it was in such a state of disrepair coming in. And financial status, this was the largest factor that weighed against him. That is normally the key. Substantial outside income usually implies the activity is a hobby used only for its tax benefits and the personal enjoyment of the owner. The court ruled that the qualitative factors, business-like manner, expertise, and hard work, outweighed the financial history. Right. The facts. This is a wildly fact-dependent case. Understand that. 99 times out of 100, if you have a situation that looks on the, just overall first glance, you find these huge losses, wildly profitable oil leases that could pay for the losses, right? And, you have all of this thing. We've been going on for years. It's not showing signs yet of making money. 25,000 of revenue is hardly showing a sign. This thing is going to be to overcome the costs involved in this thing. This thing looks really bad from the start, but it had the right facts, right? So high income and sustained losses are not automatically fatal to 183. But you got to be able to have very good facts on your side. I can't keep piling up bad facts or getting strained business plans and records put together years after the fact because we got an IRS notice. Put those in here and he loses. Just very simple. He loses with that, right? The taxpayer needs to demonstrate genuine business intent through his actions and his records. Is he doing things that are hard? Is he doing things that aren't necessarily wildly enjoyable? Almost every business has parts in it that are enjoyable and parts that are, this is bad. Come on, all of us in tax season, I don't care how you look at the hours this time of year, that's not a positive, right? Putting in the hours and doing all that work and all the stress and all the other stuff and all the calls you're going to get because all of your work falls on you in a very compressed time frame. Everybody wants to know why their return isn't done yet. That group, that's a negative. If you could just do the positives, right? Yeah, I love, I really do. Weird as it sound, I love looking into these weird little tax issues and going through them. And if I could do that and beat them up and do the research and, do all the background and get all that stuff together, that would be great. But the other part comes with the business. Plus, just the standard stuff of keeping track of the business, records of the business, handling all of your HR issues in any business. Right. Not fun. He did the not fun stuff. In a ranch, there's a lot of not fun stuff in addition to the stuff that's great, but there's stuff that's just long, hard work with long, hard hours. He put in the work. And that really helped in this case. Okay, so back to our ending infographic again. The IRS challenge on the left. This combination of high outside income and high losses created presumption of liability. IRS is going to win 99 out of 100 of the cases when you have those facts, period. So this is, in essence, you need to be ready for the exam if you're looking at that, because if the exam comes, you're just losing likely. That's going to be the background. So how? Given all the factors against it, on the left side, how did they win? Keeping separate accounts and detailed logs were crucial. Very much businesslike. His expertise, his sweat equity. Believe me, sweat equity is a really big part of this. Right? Not just sweat equity because you're doing a workout. I'm talking about sweat equity doing the stuff that's nobody goes to a gym to do it. Right? It's not, and you don't get nice pictures from it. Right? And his academic credentials mattered more than the financial success. He had the background. And he could point to specific external factors. Harvey, COVID, and the big freeze in 2021, they provide a valid narrative for losses over the years in question. In essence, you can win in these cases, but you got to have very good facts. Hint, you can't paper over the items on the right side of this graphic. If you're merely papering them, and that's what people try to do, you merely paper over by doing records late, by having you go back and try to reconstruct things at the last second. Right? We try to point out some, there weren't really records of what he did, but we try to emphasize, on one day he actually did a little bit of work, and we try to build that in to cover 5 years. Nah, you're papering over. And it's really easy to fall into the trap of not really, going back and, you had bad results, and then you try to find things and then try to somehow, in very tortured logic, tie them to why things were bad. That's not what happened in this case. Everything you see on the right side of the infographic, all of that was actual. It was real. There was no papering over or sitting in the attorney's office and trying to think about something, or the accountant's office and trying to think about something to write up for a memo. Right? Can you think of this? No, it all works. This is a win, but don't read too much into this win. You've got to have very, very good facts. And even with these facts, if we come back 5 years later and this is the same story, over the second 5 years, it has 25,000 of revenue and over 2 million in losses. That's probably a loss from that point forward. Just be aware of that. Okay, next up is the case of L versus Commissioner, right? Tax Reform Decision 2026-17. Decision came down on February 10th, right? This was a rather large computer error by the IRS. Somebody won the lottery. So this is the technical distinction between a rebate refund and a non-rebate refund. Because one, the IRS has to go through deficiency procedures, and the other is they can just basically pull the funding out without going through that. So in a rebate refund, they're recovered via deficiency procedures, a notice of deficiency, which you then can take to the tax court. Non-rebate refunds must be recovered via a specific lawsuit in the district court under Section 7405. They have to sue you. So in this case, the IRS computer erroneously issued a $21,000 refund instead of a $5,000 one. They just effectively added $16,000 to the refund, right? The taxpayer argued this clerical error forced the IRS to sue her in district court rather than issue a deficiency notice, right? The IRS is trying to do deficiency, go straight to deficiency notice, the 90-day letter. You can sue them in tax court, right? All that background. So let's talk about this. There was a breakdown in the IRS's automated processing. The taxpayer perfectly properly computed an additional child tax credit of $1,400. However, the IRS computer system erroneously corrected this figure to $17,164. Notably, this erroneous figure exactly matched the amount of earned income she reported. There was a programming glitch. We're going to give you back your earned income, right? As a result of this glitch, she received a direct deposit over $21,000, far exceeding the $5,000 approximate refund she'd claimed on her return. Once the IRS identified the mistake, they issued a notice of deficiency to recover the erroneous portion, $15,764. Right? Now, the taxpayer argued this was a non-rebate refund, a clerical error. Right? Rather than a substantive disagreement over tax law, that was a non-rebate refund, right? She was a sophisticated procedural defense trying to get around this. Therefore, she claimed the IRS could not use deficiency procedures, which allowed access to tax court, was required to file a lawsuit in district court to recover the funds within 2 years after the payment. Okay. That's her argument. Now, definition of deficiency. What you see here on your screen is a statutory formula for deficiency under Section 6211A, right? The tax imposed minus, and then you have this nice little parenthesis here, the tax reported plus a prior assessment minus rebates. That's what is considered to be a deficiency. A rebate definition is the crux of legal argument. That definition are 6211B2. A rebate is defined as an abatement, refund, or credit made on the ground that the tax imposed is less than what was reported. It implies a substantive recalculation of liability. In contrast, a non-rebate refund occurs when the IRS sends money for reasons unrelated to a recalculation of liability. For example, a check printing error where the refund is sent twice or a refund is sent to the wrong taxpayer. Now, this distinction dictates the recovery path. Rebate refunds are recovered via deficiency procedures. Issue a notice of deficiency, which is what they did in this case. A non-rebate refund must be recovered by the government filing a suit under 7405, which they have not done and may actually be by this point out of statute. Right? They're not able to file that suit now. Okay. Now, key issues here that we look at the negative tax concept. Section 6211B4 is critical for modern returns with refundable credits. It mandates that refundable credits like the advanced child tax credit be treated as negative amounts of tax. This means the tax imposed variable in the deficiency equation can be a negative number. The court rejected the taxpayer's argument that a computer glitch is merely clerical. It held the computer adjustment was a substantive recalculation of her Section 32 allowances. The computer effectively determined wrongly that her negative tax liability was much lower, more negative than she claimed. The computer recalculated. Yes, it did so in a very absurd manner, but it recalculated. And that's it. And the tax court dismissed the attempt to distinguish between clerical and substantive errors. The statute only asks if the refund was made on the ground that the tax imposed was less than reported. The motive or mechanism, human versus computer, doesn't matter. The IRS recalculated her tax, claimed she got her tax wrong. It didn't issue the same refund twice. It didn't send her somebody else's refund. That's negative tax. So the calculation and the final holding, the tax imposed was a negative $4,313. This represents the correct negative tax liability based on her actual refundable credits reported on her return that she properly computed because she reported that. She did her return right. She reported it right. The problem was the government decided to essentially tell her she was wrong and basically increased her negative tax by $15,764. Because the IRS computer recalculated her credits to justify this payment, it legally qualifies as a rebate. So the formula, the tax imposed minus the parentheses, the tax reported minus rebates test. Look here, the deficiency equals the negative 4313 minus parentheses, the difference between the negative 4314 and then the total of those two. That'd be 4313 minus 20,077. And that means deficiency is 15,764. Mathematical application of the statute proves the deficiency exists. And since it was a rebate, the notice of deficiency was valid, and the tax court had jurisdiction to hear the case and rule for the IRS, which they did. Again, our nice little graphic to close it out. Right? Rebate refunds are described in the upper left. You see there. This is a substantive recalculation of the tax, even if erroneous. Right? They are recovered via deficiency procedures, a notice of deficiency. That's your structure. Non-rebate refunds are on the right. They're based on clerical errors unrelated to liability. That is a duplicate check, the same check sent out twice. These are recovered via refund suits under Section 7405. And in essence, the case study data at the bottom center highlights specific numbers from this case. The erroneous overpayment was $15,764. The IRS replaced the $14,000 credit with a $17,164 earned income figure. And the key takeaway from the case is the mechanism versus substance point is crucial. Even if the error is triggered by a glitch, if it results in a recalculation of your tax liability, including negative tax, it is a rebate, not a clerical error, and notice of deficiency was correct. As I said, the taxpayer was attempting to argue that since the IRS used the wrong method and we're in the wrong court because notice of deficiency, because she didn't pay it back and sue for a refund, right? She didn't know she went through this route. So she went to the tax court, and either, as I said, the statute's gone, which could very well be the case for filing a suit for refund, or she would prefer not to have to argue it in front of the tax court, or have to pay the money first and then go to district court. She preferred they just sued her, and we started out with she hadn't paid, and she hasn't paid, and the IRS is trying to collect the money from her with the court. In any event, she did not win on that one. Next up, substantiation and civil fraud, and why, as tax pros, we got to realize that we are held to a higher standard. This is the Goodwill Okerhe versus Commissioner. Tax Court Miranda decision 2026-18. Decision came down on February the 11th. Right. This is a stern warning to all of us in tax. This is not just a taxpayer, but a highly educated individual with a master's degree in accounting who is also a professional tax return preparer. You're not going to be cut a break. Hate to tell you that. We are held to a higher standard, whether we like it or not. Now, there were two critical errors that the IRS was challenging here. The rigorous substantiation required for business deductions and the imposition of the Section 6663 civil fraud penalty. And this highlights how a tax professional's background can be used as evidence against them when establishing fraudulent intent. This would be a much more difficult case for the IRS to win a fraud penalty on if this person was not somebody with a master's in accounting who had a long history of doing tax return work. That's bad. Right. Let's talk about the failure. Now, Jack, our taxpayer, was the sole shareholder of an S corporation, GEI, and worked as a lot attendant for a Ford dealership. He was also an experienced taxpayer. He has an interesting, professional and employment background. Now, first thing he tried to do, because records are a problem, he provided minimum documentation during the audit. He claimed a flood his residence had destroyed his records, or in the alternative, the IRS revenue agent had confiscated and lost his receipts. So the flood wiped them out. And if the flood didn't, and there was anything left here, the agent stole them. That's two interesting ideas. Well, the court dismissed the claims as baseless assertions. You can't just wildly suggest things. The taxpayer failed to file an insurance claim or provide photographs of the damage from this flood. Right? There was no real evidence of what the flood did. And the revenue agent credibly testified that he never retained original documents. Right? But Jack's saying he took them. Right? Okay. Now, he also claimed dependency exemptions for his two nephews living in Ukraine. This guy is nothing if not interesting, right? The court denied these because he offered implausible testimony and no credible evidence that they lived with him for more than half the year, requiring for qualifying child. His nephews were living in Ukraine, but as he noted, the court noted, we need him over here to be with you for more than half the year. So it was difficult to be a qualifying child, right? For property tax, he attempted to deduct property taxes paid on a home owned by his brother. The deduction was denied because he failed to prove he was the equitable owner of the property. He certainly wasn't on the title. There is an out for that if you can prove equitable ownership, but you got to prove that you would be held to be the equitable owner under state law if the ownership of that property was challenged. And he failed to show evidence of that, right? But he wasn't done yet. He also claimed significant vehicle expenses for his job at the car dealership. This deduction was denied because his employer explicitly discouraged employees from using personal vehicles. Yeah, that's not a good thing that the IRS uncovered from the employer. So his expenses were not necessary. The employer didn't want you using your car. So if you use it for business, you were doing it not because your employer required it to be done. They had other ways you should handle it. You just didn't do it. So we're losing that. Finally, his S Corporation, GEI, claimed bad debt deductions for unpaid fees. Okay, cash basis business claiming bad debt deductions. Because GEI, guess what? It was a tax basis taxpayer. Cash basis, I should say. You can't deduct a bad debt if the income was never included in gross income in the first place. I know clients have trouble understanding that, but you'd think somebody with a master's degree in accounting? Yeah, it's tough to think plausibly why he thought that was allowable, right? He also claimed deductions for day laborers, but he couldn't provide any names or Forms 1099. Just take my word. What about 1099 you're supposed to file? I didn't get around to doing them. Yeah. And he said, well, okay, I didn't have records, but Cohen. By the way, Cohen is not good to find your case normally, and it wasn't in this case. The court refused to estimate expenses under Cohen. You've got to have a reasonable basis in the evidence to estimate expenses. And Judge Nega noted that estimating expenses without any evidentiary basis would amount to unguided largesse. In essence, I'm just giving you stuff, and we don't have any idea to know what it should be. Sorry, no deductions. They're out of here. What about the fraud penalty? Well, the taxpayer challenged the penalty on procedural grounds, arguing the IRS manager signed off without speaking to him. The court cited the Bell or Woods case, declining to require proof of the depth or comprehensiveness of the supervisor's review. And the court also found for the fraud penalty, we look at the concept called badges of fraud. Right? The court found clear and convincing evidence of fraud based on several badges. The IRS does have the burden here. What exactly got him in trouble? Sophistication. The taxpayer was an experienced tax preparer. He knew the law. Follow it, but he knew it. Right? Inadequate records. He failed to provide documents, forcing the IRS to summons bank records. Right? And he had implausible explanations. He had inconsistent stories about the flooding IRS agent's conduct. Well, which one got the records out of here? Right? So that undermined his credibility. And so the ruling, the 75% civil fraud penalties, that means in addition to the tax he was assessed, add 75% to that, right? The court effectively stripped away defense of ignorance or mistake because he's a tax pro. We lose those defenses, right? So that's key. Professional status meant the fraud penalty was pretty much a given. So here again, tax fraud penalty. What are our lessons from this case in the fraud under, and this again is civil, not criminal. He's not going to jail. He has civil fraud, right? Okay. The profile of why he lost the penalty. He's professional expertise, a master's in accounting. That was a double-edged sword to help establish intent. That led us to, he knew better, but he just kept overestimating his deductions. End of the day, we see the 75% fraud penalty imposed. That's how you get there. The badges of fraud, what were the key problems he had? Those are on the right side. We have the broken record icon, symbolizes the implausible flood defense, right? Just every time he had an excuse for everything and no evidence of the excuse. That's never good. The safe subpoena icons represents the refusal to cooperate, requiring the IRS to summon bank records, right? He wouldn't provide anything. And the car icon is just part of his overall lack of substantiation. And while the car is one of the bigger ones, he didn't have any substantiation for his right to claim that. That was far from the only thing he failed to substantiate. The systematic overstatement of deductions for personal items is a clear path to civil fraud penalties. And that's how he got there. As you look at those disallowed, you look at the claimed versus the disallowed expenses, right? What he claimed is, if you have the screen up, or you're looking at a printed version of this in color, or just a PDF, which would be in color on your screen, you notice that the red bars are what he claimed, and the zeros are what were allowed. And that got you the same 5% civil fraud penalty. Again, this one was bad facts, bad facts all around. And while I would prefer that even an unsophisticated taxpayer not do things like this, they are far less likely to get the same 5% fraud penalty. Now, consolidated return issue, or how to foul up your amended return. This American Guardian, I'll get the name right, Holdings versus United States, case number 1:23-CV-01482 from the Northern District of Illinois. Decision came down on February 12th of 2026. So, this is a refund suit in question. This is a tale regarding consolidated return regulations and how not to do a claim for refund. I guess is kind of the best way. The court dismissed a $1.3 million refund suit on the merits of the tax calculation, not on the merits of the tax calculation, whether they were owed it. They may have been owed it. But because the amended returns filed were not properly executed or duly filed, and therefore they missed the requirements, right? It illustrates that in consolidated return practice, strict adherence to regulations regarding agent authorization, signature, and supporting schedules is jurisdictional. A failure here can prevent the court from even hearing the case. And I should say it goes beyond even the consolidated return. That's a specific reg looked at here. You got to follow the rules. You're filing a claim for refund. You got to make sure you do a proper administrative claim filed within time frame. And that's where we're going to find huge problems with this whole structure. Okay, this case involves a refund suit for 2015 tax year where the taxpayer sought a refund of approximately $1.3 million. On the original return, AGH filed that return as a consolidated group with American Guardian Warranty Services, AGWS, listed as the common parent corporation. Now, somehow they decided they needed to amend this. Something's wrong, and the court didn't spend a whole lot of time on exactly what was wrong. But what they do was try to just get an amended return through the door. The first thing they sent were amended returns, but they were marked as non-consolidated. They contradicted the original filing. Those amendments were filed by AGH, not by the original parent, AGWS. Remember, AGWS was the parent. The tax was paid. It's their return at this point. But we're doing our amendments using what was claimed to be a sub, right? And it was also not signed. This first amended return was never submitted to the IRS when prepared and was not signed. It did get eventually sent to the IRS with a second amended return filed later, but it still was not signed, right? Now, the government moved to dismiss, arguing the court lacks jurisdiction because the refund claims were not duly filed due to a number of procedural errors. So let's take a look at what we've got. So let's talk about the legal requirements for jurisdiction of the court. Under Internal Revenue Code 7422, so 26 USC, right, a taxpayer cannot use district court unless they have first filed a valid refund claim with the IRS. This is the only way you get in the door. You must have this ticket to get in. So, what is a refund claim, a valid refund claim with the IRS? Under regulations, right, that you're going to find, they require a claim must set forth in detail each ground upon which a creditor refund is claimed and facts sufficient to apprise commissioner of the exact basis thereof. Now, under consolidated regulations, right, consolidated rules, not regulated under the code, Section 1502 grants the IRS broad authority to regulate consolidated returns. A key rule is that the parent is the sole authorized agent to act for the group. As I said, it was AGWS's return, and AGWS has to act for the group, right? Also, a document that is not verified by a signature on penalty of perjury under Section 6061 is legally never a tax return. Those are key factors here. So what about the regulatory violation? The court noted that this was not just simply AGH missing a box. They affirmatively selected non-consolidated status on the amendments, which fundamentally altered the nature of the return in violation of the regulations. Also, there was a huge data gap. The amended return claimed an $18.9 million reduction in income based on a single line of text explanation. Not exactly adequate notice, shall we say. It failed to attach amended consolidated financial statements or identify which subsidiaries are involved, making it impossible for the IRS to even attempt to verify the claim. Just, hey, you know what? I need $18.9 million overreported my taxable income by overreported my net taxable income by $18.9 million. And I'm not telling you if it's too little income, or too much income, if I report additional expenses. I'm just telling you that's what it is. The signature. While the second amended return was signed, the attached first amended return, which contained the bulk of the calculation, was not. And the court ruled the signature on the second return did not attest to the truth of the attached unsigned document. Therefore, that was an unsigned document when they did their second return. And also, the problem is, since AGWS was the parent, only it had the right to file an amendment, not AGH. So as the court said, this was not just a single minor foot fault. This was a series of rather significant errors. And eventually the clock ran out. Right? Now, what happened here was the taxpayer argued for substantial compliance, arguing under the Florsheim decision, right? The IRS had enough information to figure it out. The court said, you got to be kidding, right? These errors are fundamental. Failing to sign a return, filing as the wrong entity, and flipping the consolidated status went beyond mere little technicalities. I mean, they got no clue what's going on here, right? The court explicitly stated the IRS is not required to piece together information from different filings to figure out what you're doing. You must file, generally you need to follow the instructions. And while, you may argue that you kept the statute open to perfect a claim sometimes if you've done adequate work, which wasn't really going to work well here, but that had been your claim. But they didn't do that, went straight to court, right? So the case was dismissed under Rule 12b-1 for lack of subject matter jurisdiction. There was never a proper return there. Even an informal claim for refund, you're going to take that up, or, When you're trying to do a protective claim, you're going to take it up to the corrected thing eventually. And then the IRS either accepts or rejects the claim. But here, the IRS simply claimed you never actually filed one. And, we're going to kind of reject your final attempt as untimely. That's, they're saying, yeah, you never did file one. And you never attempted to perfect it. And you're just out of luck. So this is a crucial takeaway here. Amended consolidated returns require strict adherence to regular filing status and agency rules. And that is important. And remember, because it was consolidated, you can't flip the lead corporation. The parent that was established when the return was filed has got to be the entity filing the amendment. So essentially, you got to understand how that works, right? Close is not good enough. Well, this isn't even close to establish jurisdiction. So again, with our nice little graphic here, the fatal filing errors, they were many, right? The first, one that was missing signature was just invalid, period. The $18.9 million adjustment just claimed on the second one without supporting financial statements was incomplete. We had no idea where the number came from, right? And switching from consolidated to non-consolidated without explanation also is not going to be anything that's going to be allowed, right? The legal ruling was on the right side there. The court cannot hear a case if the claim was not duly filed. The court said there was no duly filed claim. As such, you don't have the ticket. Your ticket's invalid to come into this courtroom. As such, it's dismissed. And since we are most certainly past the time frame, in fact, I know we are, the case tells us that, past the time frame for them to file a proper claim for refund with the IRS, you're out of luck. You're not getting that money back. Right? So the timeline at the bottom shows the progression from the original 2015 return to the botched amendments ending with the dismissal. Right? That's basically when we got into that, right? We finally got a third amended in 2020. That was after the statute closed. And that was also done on a fundamentally different concept. Now, I suspect somebody thought it should be done. They decided to try to get something in there. They tried to do it quick and dirty. Eventually, by 2020, they may have actually had somebody competent in there who figured out what was done, what this should have been done, how this should have been handled. But they were too late. That's how it goes. So again, this has been the current federal tax developments for the week of February the 16th, 2026. My email address is on the final slide, edzollers@currentfederaltaxdevelopments.com. You can email me there with some quick questions about this. I also do follow the Connect groups for the Arizona, New Jersey, Idaho, Illinois, Washington, etc., and Minnesota societies. So you have questions there. If I see something I think I might be able to help, I'll try to answer back. But otherwise, hopefully your things have been working fine. Hey, the flood starts now because the brokers all have to get their stuff out, right? Or at least their stuff, and then say that they may be updated later. So I don't know about you, but the brokerage final consolidated 1099 started arriving last week, and the returns started arriving, right? We went from having very little in the office to having a flood of things in the office. So probably I suspect a lot of you are there. We will try to keep this up during tax season as best we can. Keep what's going. I will probably have an easier time keeping going the website, so currentfederaltaxdevelopments.com, which has the updates from day to day. That's now, I can efficiently process that much nicer these days. See, Notebook LM is really useful for that. It cuts it down so I become a technical reviewer and not have to actually author up all the text to get started. We're simply trying to summarize a court case or summarize a ruling. So it helps. Technical reviewer is much simpler for me and much easier, and that's how we're doing that. So just so you understand what that is. And we'll go that route. But otherwise, we will see you next week. Hopefully, we'll talk about some more current federal tax development.